I'm Richard Calhoun, Creekside Realty, 40 years of working here in Silicon Valley, working with buyers and sellers. We're talking about the weekly real estate impact. The URL in green is the base URL. To get to today's archive, you add in 2020 1031, the date code. To get the handout, you put in handout in the date code, and we're up to 112 slides, and that is posted for anybody that wants to get it. All the future presentations are get here by doing 2020. My big concern, and it's not a huge concern yet, is you'll notice this is talking about the active listings that don't have an underlying offer on them, so available for a buyer to purchase. The blue line is this year's data. So we're now in week 43, and you can see we're now starting to get up significantly above the gold line. That's not because we're having that much more inventory coming on in the marketplace, but it's because normally we have less inventory coming on. And one of the things I've noticed with COVID is the holiday impact is just not as severe. And that's what we're seeing here. Normally, this is the end of the year holidays, slowing down the number of listings that are on the marketplace. And right now we're plugging along straight across. So we're starting to get more inventory than normal. Now, the reason this isn't alarming yet is this trend hasn't happened for very long, so the delta is not very much. But now if we start looking at the number of new listings, the difference is a little more noticeable. The gold line is the 5-year median. The 5 years are 15, 16, 17, 18, and 19. The blue line is 2020, and you can start seeing, starting in week 37, the blue line is now significantly above the gold line. Yes, it is falling down, but it's falling down at quite a bit higher level. And if you put numbers on it, this last week we had roughly, I call it 513 maybe new listings coming on the market. That might be a little generous, but over 500 new listings on the marketplace. And normally at this time of the year, we're down here under 400, something like 375. So we've had 130 extra listings come on the market in 1 week. That's only one side of the equation. So now we have to look at what's happening to the offer side. And that's what this slide's saying, that the blue line is above the gold line, which is good, because that means we could potentially be getting rid of that extra stuff. But if we look at the magnitude, the number of new offers is only around 450. So if we have somewhere around 505, 510 new listings coming on the market, and we're only selling 450, we're actually increasing somewhere around 60 new listings each and every week. And after a few weeks, that can start changing the dynamics of the marketplace. Now we look at the days of unsold inventory, which is that ratio between the supply and the sales, and the lower the number, the faster the marketplace. So if you can see, I talked about starting at week 37. From week 37 to now, we've been basically flat. We've been having some perturbations as we've had an offset. So far, even though there seems to be a difference, that difference is so far only lagged by a week, and so the DUI is really not increased. So if you look at this, DUI is sitting there somewhere around 35. The highest we got was probably about 39. The lowest we got was about 30. So we're in a fairly tight window. Anything below 40 is what I call a strong seller's marketplace. From 40 to 80 is sort of a balanced marketplace. No alarms yet of any kind. But again, and right now we're faster than the 5-year median. And again, those 5 years that I'm comparing it to happen to be 5 good years. So we're having a better, or at least a faster market than the last 5 years, which were all good, fast marketplaces. Now, if we look at the number of new closings, this is basically the new offers lagged by about 30 days, the length of the duration of the typical escrow. Same concept. You can see the blue line, the number of closings are going up. The number of closings based on the 5-year median are normally flat. And so the ratio of them, when you compare them, is going up. And we're somewhere up around 135% of the number of closings we normally would. So believe it or not, now that this red line is above the red horizontal line, every time it is, so you got a little mountain here, a little bit here, a little bit here, a little bit here. All these start adding up to make up for the shortfall that we had back here when shelter in place was first announced. This is now looking at the number of expired listings. You can see the expired listings were above, by seeing the red line is way above the red horizontal line, you can see that the blue line was above the gold line. So we've been having more expired listings than normal. But now for the last several weeks, basically starting maybe at week 35 forward, it's been absolutely normal. This is easy to explain if you understand the MLS, and that's simply that the listings that were withdrawn when shelter in place was announced expired during this period of time, resulting in a surplus number of expired listings. The bulk of those have gone by us now because most agents don't take listings for more than 6 months at a time. And so now we're just having normal expired listings. Also, expired listings really are not a big part of the marketplace. If when you look at the volume of this, you're talking about somewhere around 20 listings. And when you're talking about 50 sales and 50 new listings, 20 really doesn't make a big difference. Now we're looking at the number of cancellations. Here, except for right at shelter in place, the number of cancellations is essentially 100% normal. So, we're having a normal year compared to 5 great years. And now withdrawn listings, I have no history on this because once an expiration date is hit, a withdrawn listing becomes an expired listing. So there's very few withdrawn listings over about 6 months old. So there's no way to go back and get a 5-year history on it. But you can see the magnitude here is really not that high. It is higher than it was at the beginning part of the year, but at the beginning part of the year, you have very few listings, and more significantly, you have very few listings that have been on the market for any length of time for sellers to give up on the marketplace and want to withdraw. And this is just looking at the components. So if you look at the available inventory, that's the blue line. You can see it's been basically right at 100% of normal ever since shelter in place was announced. So you had a huge number of listings withdrawn, but you had a huge number of sales that never happened. So the inventory, the supply, the reservoir of listings stayed level. And basically all year we've had level inventory. And now you can start seeing it's going up a little bit. If you look at the number of new listings, you've had some perturbations here, and these were the different holidays, because normally a holiday like July the 4th and Labor Day negatively impacts the real estate activity. So this year, when it wasn't negatively impacted, you had this big surge up. We also had the fact that it was delayed by 1 week because I think Labor Day was as late as it possibly could be this year. So that's what causes this kind of fluctuation. But basically, starting here at week 35 on, you've been having more number of new listings coming on the marketplace than you would expect. But the only reason the market really isn't going anywhere, slowing down dramatically, is the gray line. The number of new offers is doing the same thing. And so far, you can see that it's just shifted. Here's your peak new listings. Here's your peak new offers. You had a valley, you could almost just shift those 1 week and boom, they'd be a perfect match. Like this valley matches that valley, this peak matches that peak. So far the buyers are keeping up with the additional sellers. And then the last thing you look at is the number of new closings. Gold line is above the horizontal line. You're gaining transactions. So basically, if you go back to maybe here, like week 28 on, you've gained a few here, you gained a few here, you gained a whole bunch through here, and that starts whittling away on this deficit. And this deficit, remember, I worked that out, was about $4 billion. So, if I guess, just looking at it, we may have gained $1 billion back here, maybe $500 million here. So if I was to recalculate the numbers now, the loss may have only about $2.5 billion. Now we look at the frequency and magnitude of overbidding. This is going to be the frequency of overbidding, and it tells you how common it is for overbidding. So we're north of 60% of all single-family homes, condos, townhouses in both San Mateo and Santa Clara County are selling for over asking price. And if you come up here, you can see the magnitude, and that number is right about 103%. So sellers are getting about 3% more than they're asking, and 60% of the time they're getting more than they're asking, which means about 35% of the time they're getting, actually probably closer to 30%, they're getting less, and about 5-6% of the time they're getting exactly what they were asking. This is a little bit different. It's the same concept, but I went back and got these best Octobers are now the best October, but the 35 days. So it's starting on the 1st of October and going forward. So that really is about 35 days. So I guess the real change comes up later. So the red line is this week's data, and you can see it's near the top of the pack, but probably last week was probably a little bit better. You can start seeing down through this area here, the red line's down here. It's no longer the top. You sort of see the gold line, the 23rd, and even the blue line, which looks like it was back on the 3rd, were better in this area. So it's near the top. The range is from the dotted line here to the first dotted line, because those are the best October and the worst October. So you're in the middle. You're towards the top of what we've been doing in recent weeks, which is really not bad when you consider what we've gone through. Here is just the same data with less data points, but now you can sort of start seeing a little bit better. There's probably 3 lines that are better right in this area, 2 lines better in this area. Up here, it's probably the second best line. So, the distribution when you're looking at only 1 week of data does fluctuate quite a bit. But again, it's near the top of the pack. So the market's performing better than it typically does. This is the same thing, but here's, I guess, where I did the change. This is now comparing macro data to macro data. I used to compare it to single family data and just say, it's close, it's the best I had. But this last week, I was able to go back and all the way back to 1997 and generate the macro data. So all these historical lines are looking at single family homes, condos, townhouses in both San Mateo and Santa Clara County. So what this is really saying when you look at it with the red line through here, a good part of the marketplace, we're having the second best year for this week than we have compared to October. So I'm not comparing, the benchmark is not just this current week, which is I think week 46. The benchmark is October, because if you take a week for a benchmark and compare it to a week, both of which don't have a lot of data points, you're going to get a lot of fluctuation. So the benchmark is a full week. So I start on the first of the month for October, but the key change is instead of it just being single family homes in Santa Clara County, it is now that macro data, single family homes, condos, townhouses in both San Mateo and Santa Clara County. What you don't know here is part of the marketplace doing really well and part of the marketplace not doing so well. This is just, a global look at the marketplace. Same concept now, but the more recent years, and you can see a little clearer that the red line is basically the best line we've ever had, except for 2017, which was that crazy phenomenal year where we basically had a round of appreciation in the first quarter like we typically do, followed by a second round of appreciation in the August timeframe. This is a new little table, and 2020 is 1 week's worth of data. These are all year data. So not year data, but monthly data for the given year. And again, it's macro data, so it's consistent. But you can see the median days on market is 10. And if you look back, you've never had lower than 10. Even in 2017, you were at 10. Now in 2017, the average days was 17. We're now at 21. So our average days are a little bit slower. If you look at the magnitude of overbidding at 102.7%, you had 103 in 18, you had 108% of overbidding in 2017. That just gives you an idea of how much of an outlier that was and why that graph has shifted so far up on the distribution. 102%, 104%. So you can see the magnitude of overbidding isn't so high, even though the market's really fast. And I explain that because every time there's an insult to the real estate market, the buyers are a little tighter on their purse strings. So they're not willing to bid as aggressively up in price. Now you look at frequency, which doesn't get hit as hard. You're basically at 61%, which is pretty good now compared to 2018. They're right at the same order of magnitude, where on the frequency, the magnitude in 18 was greater. But if you come to 17, that's still much higher at 78. But if you look at the frequency of overbidding, it's right there. 2020 is right there with all the previous best years we ever had. And if you come back to the early 2000s to late 2000s, we're way better, because you're talking about only 25-30% of the sellers getting more than their asking price. Then you get a little bit down here on price, a little bit more fluctuation, and that's because, and this is the reason I typically don't combine single family and condos. If all of a sudden the condo market is doing better, the median price will drop, even though property values haven't dropped. So in my opinion right now, the condo market isn't doing so well. So even though prices are pretty flat, it looks like we've had almost $150,000 increase from last year. And I would maintain a lot of that is because we're selling a disproportionate number of single family homes compared to a normal marketplace or compared to last year. And those single family homes tend to be more expensive, which brings up the median values, which has nothing to do with property values. And this is a great example of why it's important to look at the micro markets, because you can have a shift in the marketplace that makes it look like there's appreciation or depreciation that are just really not there. The one thing I really wanted to point out is the number of closings, 2,269 closings. I mean, we're outperforming that 2017 year by almost 10%, or exactly 10%. So that's pretty phenomenal. We're talking about having the best year we ever had, and I don't think we'll ever see another year like 2017, but now we're selling 10% more homes. So there's a lot more activity in the marketplace. And if you go back and look, you have to come all the way back to 2009 to get to the same order of magnitude. Yes, it's less, but we'll call that the same order of magnitude. And then you have to go back all the way to 2005 and before to have more activity. Why was there so much activity back here? Back here is where there was all those liar loans where you could basically say you made $1 million a year and you could go off and buy whatever property value you wanted. They didn't verify your income. They didn't verify your down payment. Well, they didn't verify the down payment. They did 100% financing. And so I have heard from friends of mine that were aware of transactions where a person on minimum wage went out and bought $1 million property back in 2005 by just saying he made more money than they actually did. This chart is going to go away next week, and the major reason it's going to go away is not even the workload, and it is a fair amount of work on it, but I'm comparing the marketplace now to the marketplace the week before shelter in place was announced. And, we're comparing mid-March back to mid-February to October. And October has nothing to do with that mid-February to mid-March timeframe. So the fact that the market's stronger than then is becoming more and more irrelevant. But it is noteworthy still. You can see the condo market has a fair number more buyers on here than the single family homes. But the concept is this is where the market was for each of the different metrics before shelter in place. This is where it is currently, and the change between the two favoring the seller or the buyer. And you can basically see in single family homes, the most of the areas are favoring the seller. A few of the areas are favoring the buyer. In the condo market, it's evenly split, maybe a little bit more in favor of the buyer, because when you really look at the nuts and bolts, this is the county, so you ignore that. So basically out of 6 areas, 4 are favoring the buyer and 2 are favoring the seller. And then frequency of overbidding, it's pretty much in the single family market. It's either the same or favoring the seller. On the condo market, Santa Clara County is favoring the seller, but the San Mateo County is basically favoring the buyer. And a magnitude of overbidding, the condos are basically flat. Even San Mateo County is basically flat, but Santa Clara County is really favoring the sellers. And basically across the board on prices are up in the single family category, and they're basically flat in the condo market. What I found interesting was the fact that they're up in San Mateo County. And why that's interesting is your frequency is down. So you're, somewhat favoring the buyer, and even your days of unsold inventory, and this is the biggest shock, is up around 70, 65, or 61. That's a lot of inventory. That's basically becoming a buyer's marketplace. But even though it tends to be a buyer's marketplace, you have $70,000 up in the Bay cities, which are the cities on the Bay side of the mountain ridge. Even your North County area, which is like Pacific, Daly City, San Bruno, they're up $80,000, which is more than 10%. So it doesn't make a lot of sense. It could be a shift maybe, and this would be almost my suspicion without getting into looking at the micro market. It's very probable that the cheaper condos are what's not selling, because the trend right now is people want more space. They're going from condos to townhouses to single family home, Campbell to Morgan Hill, all to get more space, because now their home is more than their home, it's their workplace, and they need more space. So the very low end of the marketplace is probably not selling as rapidly, and because it's not selling as rapidly, that causes the prices to drift up without there being appreciation. Now we're looking at days of unsold inventory in single family homes in both counties. And so you have the data over here, so you can actually look at it. The trend is the same as I've had for the last several weeks. The redder the color, the faster the marketplace. So you can see that South County is the absolute fastest. Cupertino, Sunnyvale is very close second. Actually, I take that back. Milpitas, Blossom Valley, Santa Teresa is absolutely the fastest. And I have notes here so that it keeps me honest as well as everybody anybody else. From 50 to 70 days of unsold inventory, there's no color. So for example, here in Los Altos at 46, it's a very pale pink because you're just below 50, so you should be hotter than no color. And then if you go to Menlo Park, Atherton, here it's at 65. That's in the middle of this, so that should be no color. And that pretty much looks like it's no color. So that's the concept. This 24.5 down here is the point at which I'm saturated to red, and faster than that doesn't get any more red. And that's why South County, Milpitas, Campbell, and Cupertino, Sunnyvale, essentially this whole blob is all the same color. Because once I get down to 24 and a half days of unsold inventory, I've run out of intensity of red, and so it's all the same red. So there's a gradient from 24 and a half up to 50, and then from 50 to 70, there's no color. From 70 to 121, I go to blue, and above 121 days of unsold inventory, there's no greater blue color. And right now, there's no blue on this graph at all. Same exact concept here for frequency of overbidding, but we're doing a different metrics. Now you can see that Menlo Park, Atherton has come in with a little bit of a blue color here because it's at 36.9 days, and you can see 42.5% of overbid is no color. Anything below that, all the way down to 20 when I get saturated in blue, is getting more and more intense blue. From 42 and a half up to 75, I'm getting more and more intense red. So the only area that I'm picking up right off there's two. The San Mateo County North area up here, the San Bruno area, and the Milpitas, North Valley, Blossom Valley, Santa Teresa area are the same maximum intensity red because they're at 77 and 82.8 days of unsold inventory, greater than the 75. The one that's really close is Foster City right here, but if you have real good eyeballs, you should be able to see that that's a little bit less red than here. And my eyeballs aren't that good, but that's what the numbers in the computer would tell me. Now we look at the magnitude of overbidding, and it's the same concept. Notice the intensity is down quite a bit, and that's because I go all the way up to 110% before I get to saturation, and nothing is close to 110%. The hottest areas appear to be Milpitas, North Valley, Berryessa, and Santa Teresa, and Cupertino and Sunnyvale, both at about 105. Cupertino and Sunnyvale is a little deeper. So that I can almost argue, I could see this being a little redder than this area over here. So it's a quick way of getting an overview of where the hot spots in the marketplace are. Now, this is median price. This is not what's happening on whether prices are going up or down. This is just where are the more expensive areas. So the redder the color, the more expensive areas. The bluer the color, the less expensive the areas are. The Redwood City area in San Mateo County is white because it happens to be the median with no color whatsoever. So you can basically see that Redwood City is white. The base cities are a slight pink, probably followed by this area, which is probably Cupertino, Sunnyvale, a little deeper pink, followed by Saratoga, Los Gatos, followed by Los Altos, Palo Alto, followed by Menlo Park, Atherton. So that's as you're going up in price. As you go down in price, you're sort of tied between East San Jose, Central San Jose, the coast, followed by Berryessa, Milpitas, Santa Teresa, Blossom Valley, followed by Morgan Hill, Gilroy, and South County, Central San Jose, South San Jose, and East San Jose being the cheapest areas. So you can quickly see what geographical areas different prices are. We've talked about this slide. I haven't updated it since the 9th, so I'm not going to spend time on it. I think I'll delete that as well. And that hits me with the recap, so I'll pause for any questions before we continue. Now what we're going to do is just look at the frequency of overbidding, and we're going to go do a 5-week jump back. So we're going back to October 3rd. It also requires closings, so that's back another 5 weeks as far as when the offers were negotiated. But you can see real roughly where the colors are red is where the market's the hottest or getting the most frequent overbidding. And I did have a problem in color coding here in the Atherton Menlo Park area, which is corrected going forward. And that's where we are today. So this is the light blue that it should be. You can see some of the more frequent overbid areas South County is now in second place at 61, well, I guess third place at 61%, maybe even fourth place. But, you can just see the marketplace in a quick look. This is what's telling you what the market's doing today. And that's because this tells you how quickly the existing inventory would sell at the existing rate of sales. Now, even this is somewhat lagging because I use a 5-week period to determine the velocity of sales. So it's sort of an average of the past 5 weeks. And we're the past 5 weeks starting on October 3rd, going back in time. And then I'm going to step forward too for 5 weeks. And now this is the current week. And I am working on trying to get it so the slides are all the same so they don't jump. Now what we're looking at is Santa Clara County micromarkets, single-family homes on today's date. So you can come and pick the number of any particular micromarket area that you're interested in. This is San Mateo County single-family homes, and this is condos and townhouses in both counties. This is single-family home data because of only having 1,100 homes. So this is data for the month of September because we're just now closing October. And I also go up for 4 days into November for my October data. So I'll have preliminary data for November for next week. And then the second Saturday, we'll discuss the monthly data in detail. This is the unsold inventory for each of the micro markets. What you'd be looking for is trends here at the end. Are these lines going up, which would be a slowing marketplace? Are these lines going down, or are these lines horizontal? And basically, I would say these lines are, for the most part, horizontal, which says that no area is really getting worse. Here's the county data so you can see what's happening. Santa Clara County in the red, San Mateo County in the gray, and condo townhouses in the yellow. The biggest takeaway remains the same. The condo market was the fastest before shelter in place. It's now the slowest. So it got hit the hardest. San Mateo County and Santa Clara came out roughly in the same ratio. But what is interesting through basically this whole period of time, except for right here, San Mateo County has been going slower than Santa Clara County. That is the opposite of what it normally is. Normally, San Mateo County is a faster paced real estate market, but it hasn't been that way for all of 2020 for whatever reason. Now we look at the median days on the market. Here's the data so you can see it. You're basically down here at what I would say is 8 days on the marketplace in Santa Clara County. San Mateo is actually climbing. This would be 11, so this would be 12. You're at 12 days, so you can start seeing it's a slower paced market. And condos is quite a bit slower. If I was to guess, that looks like what, 2 off of it. So that looks like 13 days. Yeah, so there's 1 day between them. So the fastest you should expect a home to sell is in Santa Clara County. And in 8 days is pretty incredible. Basically what 8 days says to me is sellers are selling their home, 50% of the sellers are selling their home as soon as they're willing to look at an offer. And it's probably greater than that because some agents like to do a 2-weekend exposure to the marketplace and others do a 1 week. So if you're doing a 1 weekend exposure, you're going to be on the market for close to 7 days by the time you expose it to the marketplace, go through the weekend, look at offers, and accept offers. And if you look at it before shelter in place, you were down here below 10. And frankly, Santa Clara County was 8 before, and it's 8 now. San Mateo County was at 10, and now it's at 12. I think in general, I know I'm leaning to 1 or 2 extra days on the marketplace just because you can't get everybody through on the weekend because you can't have 200 people through a house on a Saturday or a Sunday. Now we're looking at the current inventory. Here we can view the total data slides because geographically the areas fall apart based on their size. So you get Santa Clara County single family homes at the top, followed by condos, townhouses in Santa Clara County, followed by San Mateo County single family homes. And you can see before shelter in place, they were roughly the same magnitude. There are more condos now on the marketplace than the single family homes, which would tend to tell you that the marketplace is just a little bit slower, a little less active. Now you look at the number of offers on the market in the last 5 weeks. You can see Santa Clara County is just up there, and basically we just had our record high number of offers accepted. That is pretty unusual. That normally happens during the month of May. The month of May this year, we were way down because of shelter in place, but to have it happening essentially in the month of October is nothing I would have ever expected to see happen. It's been a lot flatter this year. It's clearly not trending down yet, and I don't have the previous year data to show number of closings. That's going to go up, and you know that that's going to continue to stay flat for at least probably another 5 weeks because of the supply coming in with the number of offers accepted. Here is the frequency of overbidding, and you can see the trend is slowly up in the single family. You can see the condo is pretty flat. And in general, that's what I find about the condo townhouse marketplace. It tends to be a lot more stable than the single family home. The single family marketplace fluctuates a lot more. Now we look at the magnitude of overbidding. And again, these single family homes are just going straight up, and I think it's going to continue to go up for longer. Simply because I think it's still artificially low right now because people are hesitant. And if you're hesitant, you don't overbid as dramatically. Here is sale price. This is the cheapest 10% of the three components. And again, you can see the condo market is going up, it appears, when you look at the cheapest 10%. But again, if there's a shift to higher expensive condos, that the lowest 10% is going to go up in value. It doesn't mean property A has gone up in value. And I would almost think in the condo market, property A is probably the same value as it's been. Then you look at Santa Clara County, single family homes, and it's pretty flat. San Mateo County is a little more fluctuating, but also pretty flat. Median price, now this gets to be a little bit more indicative because it's the middle part of the marketplace, and you can see Santa Clara County has been very flat. It's been going up this last couple weeks, which is a little surprising because of the flooding in the marketplace. But remember, for sale price, this is what happened 5 weeks ago, and that was before, that was right at the start of the flood of the marketplace. So, and the flood really isn't a flood. Still there seems to be more pent-up demand than there is pent-up surplus inventory. So, but the big takeaway on all of these is basically prices are flat. The one thing that you can unequivocally say, prices are not falling. And that's what I think a lot of people, including myself, thought would happen with shelter in place. Now we're looking at the top part of the marketplace, the top 10%, which is the 90 percentile. And you can see in San Mateo County, where you're talking around $4 million, there gets to be a lot more fluctuation. You were back at $4 million here, now you're at $3.5 million more recently. Does that mean that a $4 million property lost a $500,000 in value? No, it's just a mix of what happens to be selling in any given period of time. When you're looking at only 10% of the marketplace and you're looking at the high end, there's a lot more variable in the prices. Duration of escrow, really no big takeaway here or any real impact. You can see we've slowed down. We were in San Mateo County, we were down at 25 days duration of escrow. Now you're at 30. Pretty much everybody's leveled out 30 days, which says you can basically close a transaction fairly easily in 30 days. This is the speed for 50%, so 50% are taking longer. I know I professionally prefer slower. So that brings us through the whole slide, and I'm open for questions.
Very good presentation. Thank you.
Thanks for joining me, Lily, and I'll get it posted.